Well, after 40 days of a government shutdown, it looks like there could finally be an off-ramp. We saw yesterday on Sunday, members of the Senate agreed to a potential funding bill to keep the government open until the end of January. The market this morning is cheering this news. We certainly view it as a positive, but we want to be careful here. I think this is really more of the removal of a potential headwind for the markets and for the economy rather than a catalyst that's going to spark a furious equity rally from here. What I want to focus on this week is some of the data that we got in recent days, and specifically it's around the University of Michigan consumer sentiment data. And here, this is numbers that we get every month, and I think focusing on consumer confidence is so important because obviously our economy relies so heavily on consumption. We want to know how the consumer's feeling. What I took away from this data is that consumer sentiment, as measured by the University of Michigan survey, actually fell to the lowest level since 2022. Now, if we look underneath the hood, I think it's really interesting. If you look by political affiliation, normally what you see is that those who are aligned with the party in power tend to think the economy is in pretty good shape and have a fairly positive outlook on things. And that's no different this time around. We see that Republicans, those who identify as Republicans, actually think things are pretty good right now. Not surprising, we see the opposite is the case for Democrats. If we want to look through this political noise, I think it's really interesting if we just look at those who view themselves as independents. Actually, their confidence and sentiment has fallen very, very sharply. I think that's really, really interesting. It's actually the lowest since this question was first added to the survey back in 1984. So that's really interesting. I think we want to look at this in terms of where the economy might be going, what type of impact this might have on consumer spending, and certainly as we get closer to this holiday spending period, if this is something that does start to weigh on the consumer outlook and their willingness to spend, then it could have economic ramifications. So it is something that we keep an eye on. You also see a difference in those that are in the higher income tiers and higher wealth tiers versus those who are in the lower income tiers. And so right now, I'd say the weakness is fairly broad, but we are seeing a notable impact on sentiment among those in the lower income tiers and those households that don't make as much, maybe don't have as much invested in the stock market or in real estate, that haven't really seen that boost to their wealth or their balance sheet in recent years. Let's remember the fact that the top 20% of households actually own close to 90% of stocks and over 50% of real estate. And so as their values have gone higher, it's certainly nice for those who are lucky enough to own a home or a stock portfolio, but those that don't are left behind, and they're the ones that are really feeling the pain of ongoing inflation, and over time that does weigh on confidence and it weighs on spending. So these are the things that we're going to keep an eye on, and it's certainly one of the reasons that we are hopeful that the Fed will eventually be able to reduce rates even further. But of course, we need inflation to cooperate so that it gives the Fed that room to provide more accommodative policy. Well, I'll leave it there for this week. If you want to talk about any of these topics in more detail, please feel free to reach out to your financial advisor. I'll look forward to seeing you next week.